So hopefully over the last 10 weeks worth of content, I've given you enough material that you're super excited and super stoked to get your business off the ground. And you've got everything you need to give you the best chance of success on Amazon. Well, a couple years from now, once you're up and rocking and rolling, you may be interested in selling the business and getting an extra, even bigger payday. And there's nobody else in the space other than Joe Valley who knows more about this. In fact, he wrote the book on the subject on how to exit your e-commerce business. And so I wanted to invite Joe on in this module to actually share with you some of the things to be thinking about, how the process works, and how much money you actually might be able to make if you do decide to sell your business. So Joe, welcome. I'm glad to have you here. Let them know how rich they're going to be.
Hey, my name's Joe Valley. I'm the best-selling author of The Exitpreneur's Playbook. I'm also a partner at a firm called Quiet Light Brokerage, where personally I've sold about 100 million in total transactions. And through my team there, I've helped facilitate another $500 million in online exits. So I've seen a few things. One of the things I know for sure is that more than 50% of all the money you're ever going to make from your business comes on the day that you sell it. That's particularly true if your business is a product-based business like yours and is less than 5 years old. So let me show you what I'm going to cover today. We're going to really focus on shifting your mindset from that of an entrepreneur to an exitpreneur. We're going to do that by focusing on how you really make money and pay less in taxes, how valuations are really done in the $25,000 to $25 million range. And this is always plus or minus. Sometimes it's done at much larger levels as well. And then why what's missing is only good for the buyer. I want to help you avoid what I call the ignorance discount. Okay, let's talk about how money is really made and how you pay less in taxes. We're going to talk about that 50%, more than 50% of the money you make when you sell it. Here's an actual example of a product-based business with cash flows over a 4-year period. Cash flows is not sellers' discretionary earnings, which businesses are valued off of. We're going to go into that in a little while as well. So owner cash flow from operations, not SDE, over a 4-year period. You bootstrapped your business the first year. You took nothing out of it. Second year, let's say you're doing okay. You got 50,000. Third year, 100. Fourth year, 150. So you've got a total of $300,000 in cash flow, money you were able to take out of the business for yourself over a 4-year period. Now you can double that, triple it, cut it in half, whatever works for you. This is just an example. Now, if you pay about 35% in personal taxes here, this is personal taxes, you get to keep about $195,000 or about $50,000 a year over that 4-year period. Now I ask, sell the business at the end of 4 years for $1 million, and you're going to make more by selling it or by running it. You get about $50,000 a year, or about $200,000 by running it. Now we're going to sell it, and after capital gains taxes, that's the key, capital gains taxes, which is currently less. You got to always pay attention to the current administration and see if things change. But it's about 25%, let's say in this example, ballpark about 19% on the federal side. Then it's going to change depending upon where you live in the country. If you're in Texas, you're not going to pay any capital gains taxes. If you're in the state of California, New York, it's going to go through the roof. There are other states as well where it's very low or zero. So with 25% in capital gains taxes plus an advisor fee, you get to keep about $675,000. Did you make more money from the exit or operations? Clearly, you made more money from the exit, about 3.5 times more than the money you're able to take out of the business as you're growing it and taking all the extra cash and putting it right back in inventory to keep up with growth. Total here in a 4-year period, about $870,000 in after-tax money. So there's real incentive and benefit to building a business to sell it and keeping that exitpreneur mindset so that you can take some of this, put money in the bank, put some in your retirement, pay for school funds, and have a whole bunch left over to go ahead and start your next adventure and do it again with a bigger exit the next time. I see that happen all the time. But those that do it really well set exit goals. And I like to have them do it in dollars, date, and feeling. So in my opinion, my view, success requires planning, thinking, and action. The key is setting clear goals and then implementing a plan to achieve them. So I want you to do this right now. Go ahead and fill in the blanks. And I'm going to give you an example. I will sell my business for $1 million in the third quarter of the year 2024, right? Very specific with dollars and a date. You can't say, I want to sell my business for $1 million. You want to get very specific about the date and the dollar amount. And then the feeling part, right? It's kind of weird, but I think it's really important. Again, I've sold about 100 million in transactions, and every time I talk to somebody when the transaction's closed, I say, how do you feel? And more often than not, they say some things that are surprising. I'm going to give an example here. When I sell my business, or when my business sells, I will feel unburdened because I have money in the bank and I get to spend more time with my family. Or when I sell my business, I will feel so happy because my debt is paid off and I get to spend more time with my family. And I get to do it again and do it larger next time. The feeling you want to have when you sell your business is going to really help you connect with that goal and help you get over those rough days that you have as an entrepreneur. We've all had them. I've been self-employed since 1997. I've had some pretty rough days during that time. Now, when you've got the dollars, date, and feeling set, I want you to reverse engineer a pathway to that goal, right? If you pop into Google Maps that you want to go to Boise, Idaho, but Google can't figure out where you are now, it can't draw a proper map. You don't know how long it'll take to get there. What I want you to do is reverse engineer a pathway to this goal by learning, by figuring out exactly where you are today. So let's jump into that, starting with how valuations are really done. They're done with an earnings-based multiplier approach in this value range, right? And it's done for product, SaaS, content, and service businesses as well. Sometimes the SaaS and the service might flip to a different model if certain metrics are in place, but for the most part, it's a multiple of seller's discretionary earnings, or SDE. And 99 out of 100 times, it's done on the trailing 12 months seller's discretionary earnings. There's one firm out there that will do a multiple of months. So if it's a 48-time multiple, really what it means is it's a 4-time multiple when you talk about a multiple of 12 months. So everybody does it as a multiple of the trailing 12 with the exception of one firm. I'm not saying they're right or wrong. It's just different, and it's important for you to understand those little nuances when you're looking at other listings, trying to get a gauge for where the market is today. So this is all with inventory businesses added as a plus the landed cost of goods sellable inventory on hand at the time of closing. So you get $1 million plus the landed cost of goods sellable. And you don't even put an exact number there. You'd put 150,000 plus or minus, right? Because in this 30-minute presentation, your inventory value is going to change. So it's really impossible to put an exact figure on there. And again, there's one outlier to this. There's one firm that's out there that always includes inventory in the purchase price. I'm not saying it's right. I'm not saying it's wrong. It's just different. So most everybody, again, 99 out of 100 in this case, do it with plus the landed cost of goods sellable inventory. One does it included in there. And it makes their multiples look higher, which has benefits and drawbacks. I'm not saying it's right or wrong. Again, it's just different. And I want you to understand those nuances as you're trying to gauge the value of your own business. So now you know the formula for SDE, calculating it. The tough part is actually figuring out how to calculate seller's discretionary earnings, right? And the way it is net income plus add backs equals seller's discretionary earnings, right? So now you get net income from a profit and loss statement that you're going to export from QuickBooks or Xero, not your Excel spreadsheet, not any other kind of software. Buyers really trust QuickBooks or Xero. You can import all of your data in there, preferably have an e-commerce bookkeeper do it. And I'll talk about that as well. But it's net income plus add backs equals seller's discretionary earnings. But the difficult part of that formula is add backs. This is where most people screw up and sell their business on their own or maybe to an aggregator without doing a proper add back schedule. And they lose tens of thousands, if not hundreds of thousands of dollars. We're going to get into that in just a few minutes as well. Calculating seller's discretionary earnings, once you figure out the formula, 100% math and logic. It's easy. Just got to dig deep. Valuing the business is 90% art. That's where you really have to have an expert helping you out. Okay, we're going to jump into that valuing a business part. It's something you really need to understand. And I don't want you to ignore this just because it's not math, right? It's art. It's really important. It's the 90%. There are 4 things that buyers have consistently looked at over the years, and we put them into risk, growth, transferability, and documentation. These are the 4 pillars. And then there's you at the top. And if I was a better designer, you would be in the mortar there holding those pillars together because you are the person running the business and you are the one that they need to trust. You're holding it all together and they need to trust you. And I say that because in today's world, it's really easy to do a search for you and see the things that you're posting on Instagram and Facebook. You want to behave like a professional, same thing on LinkedIn, and not alienate half your audience or half your potential buyers. So you want to be a good person running a good business so you can find a good buyer, actually a great person, great business, great buyer. We'll go into that as well. Let's touch on these 4 pillars. And again, these are what buyers want. You always want to build a business that buyers want. They focus first on risk. It starts with size and age. The basic information on size is that the larger the business is, the lower risk it is because it has multiple channels of revenue, multiple SKUs, recurring revenue, that kind of thing. So the idea that you just want to start off small to get your feet wet and buy in a business, it goes to the opposite of what is reality, which is you're buying a really risky business because it's very young and isn't well aged. If you buy a business that's much larger and is well aged, you're going to, or build one, your buyers are going to be much more willing to pay more money. As far as age goes, the number that we see most buyers comfortable with is about 24 months, right? Anything less than that, they start to give a discount off the multiple because it's younger. So 24 months, if you're just starting out, I'd shoot your eyes on at least 24 months before you sell your business. Now, I want you to get this information in greater detail long before then. Talk to an expert long before then so you can firm up your value range and, march towards that goal with some real solid information. Defensibility, you want to make sure that you don't have one SKU that is being attacked by Chinese hijackers or any hijackers for that period there. Dependencies would be you as the owner operator of the business. Channel risk would be a single channel like Amazon, although with all of the aggregators fighting over each other to buy businesses on Amazon, it's becoming less of a risk as far as channel. And then obsolescence, right? So obsolescence would be something that may be an electronic charging station for mobile devices. Buyers would think, well, the technology is going to change, so that may not be necessary in 2 or 3 years. And they're probably right. So that's the fear of obsolescence. Growth is the second pillar, right? A buyer wants to buy a business that is growing, right? If they pay a 4-time multiple and the business grows at 25% year over year, they're going to earn their money back in 2.7 years. So they're going to look for top line revenue growth. They're going to look for bottom line positive trends as well. And then timing is really important. Don't sell a business in January that does 90% of its revenue in Q4. Otherwise, you're going to be selling a business that a buyer is going to make no money off of for 9 months. And that's not a good situation for them. The better situation is you sell it in the summer so that they get a couple of months under their belt and then Q4 hits and they're going to make a good amount of money off of it. They're willing to pay more for the business to offset any potential loss that you may have in Q4, but you're going to get a much more higher value for the business because you're thinking about your buyer as well as yourself. Growth opportunities means something that you haven't tapped out everything, right? There's still room for growth in the business, and they can grow that business because they're looking to build that business and then sell it someday and get a big return on their investment. Built-in paths to growth are really, really exciting for buyers. So let's say that you've got a total of 20 SKUs, but 9 of them you launched in the last 6 months, and they're all at least break even and growing. And in fact, combined, they represent 20% of the total revenue. Well, that's 20% of the total revenue for SKUs that have only been around 6 months. That's a built-in path to growth. All that has to happen is time needs to pass, and they're going to grow. Buyers absolutely love that. Let me warn you, though, if you're launching SKUs prior to listing your business for sale, you want to at least break even on it. Otherwise, you're going to have a negative number. It's going to hurt your total valuation. And then investments, you want to be careful about the types of investments you make in terms of the time frame where you're going to get a positive return on investment from it. Transferability. It should be said that without the transferability of the key things that drive revenue for your business, you do not have a sellable business. Simple as that. So key personalities, again, if you're the name and face of the business and people buy because of you, you're going to have to stick around for a while after closing. You're going to have to tell your buyer as you present your package to hopefully hundreds of buyers that you're willing to stick around for a longer training and transition period and be the spokesperson. You get rid of the daily grind, so you don't do that anymore, but at the very least, you're going to be the spokesperson. Key staff, another very important part. I had a key employee when I sold my last business, and I made sure that all buyers knew that that person was monetarily incentivized by me to stick around for at least 12 months after closing. And that instilled confidence in them that key staff would transfer. Manufacturers, it's great to have relationships with manufacturers and contracts with them. And number 4, and making sure that they transfer. Really, really important. No one wants to buy your business and then have to find a new manufacturing facility. They fear that, but the reality is that those manufacturers need the client. They need you as much as you need them. Workload's really important. Typically, anything under 40 hours is okay. If you're working 80 hours a week, you're going to have trouble with transferability unless you do a negative line in the add-back schedule for the fact that a buyer needs to hire somebody to make up that 40 hours. My advice is that you outsource that so your workload is less than 40 hours, and you outsource it to the type of outsourced person that you want at your price. Otherwise, your buyer is going to come in and say, look, I only employ Americans and I pay a minimum of $25 an hour. It's our policy. And they're going to dictate that instead of you. Partners, same thing. If one partner has a special skill that's really hard to transfer with the business, then that partner's going to have to stick around at least until he or she can be replaced. Okay, number 4 is documentation. Really critical here. Clear financials, not clean, clear, so that you or your advisor can pull the details out of there and build a proper add-back schedule. Accrual accounting is a must. You can convert a cash P&L to accrual after it's exported to Excel. It's a risk. It's not as accurate. It's not going to instill as much confidence, but it can be done. But a good e-commerce bookkeeper, which I highly recommend you hire instead of doing it yourself or having your CPA do it, a good e-commerce bookkeeper is the best option that can do that for you. SOPs, that's going to make your job easier after you sell because there's standard operating procedures for things to do if things go wrong. They're not going to email you, text you, call you as quickly as they want to or have to because they can just look at that sheet and fix the problem first. Contracts, again, it's great to have them transfer. Third-party reports, bank statements, Amazon reports, all of those good things, manufacturer reports, invoices, it's all got to be there. And know your key metrics of the business. That's going to instill confidence in buyers. If you've got a subscribe and save program, what percentage of your total revenue is subscribe and save in the last 12 months? How does that compare to the previous 12 months? What's the cost to acquire a new customer for you? Knowing your key metrics is going to really instill confidence in them. They may think they're smarter and better than you and can improve those, but they can't do it without knowing what they are at this point. So these are the 4 pillars of what buyers want, and they're critically, critically important. Now we're jumping onto e-commerce value ranges. And I always wait to present this because so many people over the last decade have said to me, so what are things selling for multiple-wise? The problem that I had with simply answering the question is that they really don't know a multiple of what, right? It's a multiple of sellers' discretionary earnings, but they don't know how to calculate it. And I don't want you to be in that situation. Now, I'm going to give you multiple ranges of what's happening today. Nothing is set in stone. Ranges change. They go up, they go down, and they varied very much depending upon the business. So all of my multiples are probably going to overlap here, which may be, in fact, a little frustrating for you. These are all product-based businesses, and it excludes inventory. So we've got sellers' discretionary earnings. Everything's going to be a multiple of that. Less than 100,000 to 500,000, 500 to a million, and over a million. Certain benchmarks. Remember, the larger the business, the less the risk. The less the risk, the higher the multiple. If you've got your own site, no Amazon. I know you've all got Amazon, but if you've got your own site, generally, historically, these have been worth more because you have control of the customers, right? You own that customer. Third-party businesses have historically been a little less valuable because of the risk associated with them because it's one channel and you don't own the customer. But fortunately, that's changing, right? All of the aggregators are coming in fighting to buy FBA businesses and roll them up. And by the way, they're going to go beyond Amazon now. What I'm predicting is that they're going to start buying content sites that they can drive traffic to their Amazon store. They're going to buy brands that are just Shopify stores and build that brand on Amazon. So it's all going to cross over each other, and these multiples are all going to go up, and they have already. If we had this conversation in 2016, there's not a third-party business that would have been listed above 2.7, 2.75. Buyers were very afraid of it. Now they realize it's a fairly good investment. So I've been talking here, and you've been looking at these value ranges. You see that they all overlap. That is absolutely intentional because no two businesses are alike. And this is, again, you've got the numbers, but this is the art part, the 90% art part. Someone has to dig into all of the nuances of your business to really firm up where the current value is today, so you know how close or how far you are from your goal. Again, inventory is added to the list price in the form of plus the landed cost of good sellable inventory on hand at the time of closing, not the multiple. Here's an example, though, of that. There's one firm out there that will add the inventory into the list price of the business. I want you to see it again. Let's say your discretionary earnings is $300,000 times a 4-time multiple. That's $1.2 million. But when you add the inventory in, the list price jumps to $1.35 million and a perceived multiple of 4.5. The reality is that this is a 4-time multiple plus inventory. You could look at it both ways. Again, one is not right or wrong. I just want you to understand that there's little nuances that you need to understand as you're looking at brokerage firms to see what things are listing for, to try to get a gauge for what your business might be worth and how things are changing. Okay, this is a really important slide here, the series of slides. What's missing is only good for the buyer, and I call it the ignorance discount, and I want you to do everything you can to avoid it. And that takes a little bit of training. It's going to take some work. I'm going to go over some general information here that's going to help open up your mind to what add backs are and what the possibilities are. And for those that have already sold an FBA business, if you did it on your own, you might get a little upset with me here because you're going to just hit yourself over the head with some things that you missed. All right, let's jump into them. Let's define what an add back is first. An add back is essentially an expense that is added back to the profits of the business. Think about EBITDA, right? For the express purpose of improving the profit situation of the company. SDE is adjusted EBITDA, and it takes into account the many, and remember this, owner benefits and one-time expenses that do not carry forward to the new owner of the business. These, what I'm going to show you here, are basic add backs that should be on everybody's add back schedule if you're selling on your own. Hopefully, if you miss these, shame on you. These are really obvious. One owner payroll, your mobile phone, right? I write my mobile phone off through the business. That expense does not carry forward to the new owner of the business. They've got a mobile phone. If they don't, they should not be buying your business. They've got one. Depreciation, amortization, that's part of the EBITDA. Pretty obvious. If it's on your P&L, it's definitely an add back. And then you've got these one-time non-recurring expenses that don't carry forward. A patent and a trademark. 2 examples here. These should be one-time expenses, right? You file for a utility patent this year. You get it. Your business is great, more defensible. You sell it next year, that expense is not going to recur again next year. So it goes into the add back schedule. Again, net income plus add backs equals seller's discretionary earnings, and you got to get these add backs right. Okay. In the book, we talk about the 3 different levels of add backs. This is all adapted from chapter 11 of the Exitpreneurs Playbook. There's 6 different levels layers per level. We're going to go into all of them. I'm going to do a light review here. Level 1, again, should be fairly obvious. It's one owner's salary, owner's health insurance, retirement contributions. Those are owner benefits, so they don't carry forward. Amortization, depreciation, charitable contributions, interest expense, all fairly obvious. Level 2 is a little bit more not so obvious, as I put it, owner payroll tax, right? So you've given yourself payroll, you do an add back for that, but you miss the tax line. A lot of people miss that, and it's part of the owner's salary and the payroll. So the new owner of the business may not take a salary, may take a much bigger one or much lower one. So it's always 100% add back, combination of the two. Don't make the mistake of making your estimated income taxes through your business and then not doing an add back. I've seen that happen a few times. Again, trademarks, copyrights, patents, things of that nature, legal expenses, new bookkeepers, equipment purchases. New bookkeeper, you're thinking, what does he mean new bookkeeper? How's that an add back? Let's say you're currently paying an in-house bookkeeper $30,000 a year, and I convince you to outsource to a professional e-commerce bookkeeper. So the first thing that's going to happen, let's say that you're selling your business now and you got the trailing 12 months, it's called a full calendar year, and you hired that person in July. So you've got 6 months. I'm sorry, you fired that bookkeeper in June, so you've got 6 months with a new e-commerce bookkeeper. Let's say that you pay an excessive amount for that, and it's $1,000 a month, and it's much less than that. So it's $1,000 a month before, or $6,000 a year. It's going to be $12,000 for the whole year. You're saving $18,000 over the course of a year by firing the bookkeeper, hiring a professional e-commerce bookkeeper. So in the first half of the year, you're saving about $9,000. You need to put that into the add back schedule by month. And then if you're selling your business for a 4-time multiple, you're gaining $36,000 in the list price of the multiple, in the list price of the business. It's math and it's logic. It's not fuzzy. It's clear black and white math and logic. You let somebody go, you replace them at a much lower cost. They're even better than the previous person with less headaches as well. And that expense reduction carries forward to the new owner of the business. Equipment purchases and miscellaneous stuff. I see this happen all the time in Q4. People buy new computers in September when their kids are going back to school, or TVs for the office and things of that nature around Christmas time. So those things you want to have clear financials so we can dig into those and do an add back schedule, or at the very least you can do that. Level 3, dig deep and focus. This is where I see people lose tens, if not hundreds of thousands. Website redesign. It does not recur every year for the most part. So therefore, it's at the very least a partial add back. Math and logic. Mastermind groups. Those are, for you personally, they do not carry forward to the new owner of the business. So the cost of a monthly mastermind group is an add back. And also think about, in this case, a SaaS expense, right? You're all subscribed to Helium 10, but if you're bought by an aggregator, by somebody that has multiple businesses, they're probably already a subscriber. So that expense does not carry forward. So if you know exactly who your buyer is, maybe you could argue that add back, but you don't want to nickel and dime add backs either. It's better to just do a full add back schedule. I'm going to show you one here in just a few minutes and be clear. Number 3 is where most people on their own just make the mistake and they think, this is a great perk to my business. I get all this cash back money and it's mine personally. I don't have to pay taxes on it. I get all these reward points that I get to use. The IRS hasn't figured out how to tax discounts on advertising, which is exactly what cashback money is. And it's always over there in the personal account. Some e-commerce bookkeepers will work with you and have it on your P&L, and it's just a reduction in expenses because it's a negative number. Don't make the mistake of not putting this in your add back schedule. Okay, so what you're going to do here is do an add back. You're going to set a separate tab up in your P&L, and you're going to pull the monthly amount over to the month in the add back schedule, especially when it comes to reward points, because you got to do the conversion first and then pull it over in the add back schedule. I'm going to show you an example here in just a minute. I've seen this change the value of a business by $150,000. Back to number 4, relatives or bookkeepers, replacing them with a more cost-efficient and professional person. Halfway through the year, you can make an adjustment in the add back schedule. Number 5 is pretty huge. If I buy your business and your cost of goods sold have gone up in the last 6 months, I'm going to look for a discount on your business. The exact opposite is true. If your cost of goods sold have gone down in the last 6 months, you should do an add back in the first 6 months with that reduced cost. And that's going to increase the value of your business. So if you sell 1,000 units a month and the discount is $1 that you got, it's already in the last 6 months because that's when it occurred. You go to the previous 6 months, 1,000 units times $1, $1,000 a month times a 4-time multiple is adding $24,000 to the list price of your business. Again, it's the exact opposite if things went up. So therefore, it does work for you. Math and logic. It's not fuzzy in any way, shape, or form. It has to be discounted, negotiated, and shipped and going to customers. It definitely is an add back. There's no question about it. The same would happen with reduced fees or third-party expenses there. Sorry about that, folks. There goes my, you don't need to see what time and temperature is. Same with reduced packaging fees and things of that nature, third-party fees. You bootstrap the business, right? So you didn't do the best job you could with packaging and things of that nature, but now you're smarter, you're better, you've got some money, you might redesign things. The design cost is a one-time expense, and the fact that it costs less would be an add back if you're selling the business and it happened in the trailing 12 months. It's a lot of detail, folks. I'm trying to get through this so we're in this 30-minute timeline. I would highly suggest that you get Chapter 11 of the Exitpreneur's Playbook at the very least. You can find it at exitpreneur.io. I'll give you the URL in a minute. I do give that chapter away, plus a couple of others for free. So dig into it. This is one of the most important chapters in the entire book. They're all important, but this is one of the most important chapters to help you reverse engineer a pathway to that exit goal that you've got there. So this is going to be a big P&L. I'm going to pop it up here and have you take a look at it. See if I can move myself over here. There we go. So again, you've got that net income in the upper right-hand corner, $297,000. Add backs totaling this situation, $140,000. So now your total SDE is $438,000. Here's that cashback money line, right? It changes month by month by month. $12,000 in cash back times a 4-time multiple. That'd be almost $50,000 added to the list price of the business. It's math and it's logic. If you had reward points, you'd take the reward point times the cash value and put it in each of these months. And that is math and logic as well. You can't take the value of that first class ticket that you got, for $600, but it was $8,000 and put an $8,000 add back. That's fuzzy. That's not math and logic. It does not work. So up in the top here, I put in reality, this many add backs never happens in one P&L. Never see this many, right? Again, we don't want to nickel and dime. If it's a small add back, just leave it out. 3, 4, 5, 6. Add backs, maybe 7 if they're really clear math and logic things, but never, 18 of them. That's just not the case. But this here is a very complicated P&L just to show you the power of add backs. If you look at the numbers here, if you sold the business for a 4-time multiple, you're going to be at about roughly $1.2 million on the net income. But now with the add backs here, you're at roughly you're over $1.7 million. So a $500,000 difference with doing a proper add back schedule. Even if we cut half of these out, it's a $250,000 difference. Chapter 11, Exitpreneurs Playbook, critically important. All right, now as you're going to go ahead and think about reverse engineering a pathway to your own exit, I want you to think about 3 steps to maximize that exit. Number 1, go back to setting that exit goal in dollars, date, and feeling. I want you to do that today. 2, get training and think, right? Think about all the nuances that go into this. So I want you to read, study, and train. Pick up a copy of the Exitpreneurs Playbook. And then once you've absorbed that material and you set that exit goal, speak to an expert to firm up your seller's discretionary earnings so you know where you are today. Don't ballpark it. Know where you are today. That way you know how close or how far you are from your goal. And that's very, very motivating, especially necessary when times get tough for entrepreneurs, and they always do at one time or another. And then number 3, take action, right? You're going to be given some good advice. You want to take action and shore up the weaknesses of the business and enhance the strengths of the business itself. All that's really important to do. And I definitely want you to write down your goals today. Okay. All right. You can find the book on Amazon or at exitpreneur.io. There's 3 free downloadable chapters for you guys. Chapter 11 is one of them. There's also one on negotiations and deal structures, kind of important if you're selling your business on your own. It's a $20 book. I think it'll be the best return on investment you've ever made if you pick it up and you're selling your business on your own or with an advisor. Again, I am a partner at Quiet Light. I've sold about 100 million in total transactions myself and helped facilitate another $500 million through my team at Quiet Light. We're all entrepreneurs first and foremost. We've all built, bought, or sold our own online businesses, and our motto is simply to help first. That's what we do. There are no fees. We're success-based advisors. Reach out to us. We'll give you an idea what your business is worth today so that you'll know how close or how far you are from your goal. And when you're ready to exit, if you want to use an advisor, we will be here to help.